enable.
Welcome to yet another episode of NSE FinWiz Season 6, powered by CNBC TV 18. I'm your host, Paramita Chatterjee, and over the course of the show, we'll be discussing the key principles of investment and how to make your money work for you. We are here at the beautiful headquarters of one of the largest tech giants of India, Wipro. Let's take a look.
Wipro, an Indian multinational corporation that thrives on information technology, consulting and business process services for global clients, has been a frontrunner in putting Indian IT services among the best in the world. Headquartered in Bengaluru, Wipro's 160,000 plus employees are today also harnessing the power of cognitive computing, hyper-automation, robotics, cloud analytics and other emerging technologies to help clients across 6 continents transform their businesses. NSE FinWiz is at Wipro in Bengaluru to engage with techies on the theme Invest in Yourself, Your Path to Prosperity.
It's very important for young professionals to get financial literacy. Most of our employees are joining first-time jobs, coming out of campuses, they start earning, there's a lot of freedom, and it's important that they start to understand how financial prudence is and helps them plan their careers, plan their lives better, make the right investments, and make them more secure as they go forward.
Personally, financial literacy means how well do I manage my finances and in day-to-day life. So how to manage your finances and also how you help others and to maintain the current lifestyle and how to invest.
With the increasing inflation that we see nowadays, it's better to start managing your wealth right at early age rather than waiting for surplus amount and then starting to invest into.
I think it's very important to have that wealth management because end of the day, end of the month, you're left with nothing. And if you don't want to be in a situation like that, because tomorrow anything can occur, any medical emergency or any accidental emergency, anything, you'll need your money.
Personally, to me, it's about knowing how to make the best of the money I earn and making sure that I'm starting to put away for the future because I'm somebody who personally believes you should always have a rainy day fund.
Hello and welcome to NSE FinWiz Season 6, powered by CNBC TV 18. I'm Paramita Chatterjee, your host for the show. We are right here in Bengaluru in the beautiful campus which is of the office of Wipro. And to help us really understand what financial planning is all about, let's just take you first through the theme for the show. The theme for the show is investing in yourself, your path to prosperity. We have with us Kalpesh Azhar and Mehrab Irani. Kalpesh and Mehrab, many thanks. Thanks for coming back to NSE FinWiz. And of course, we have our lively audience as well with us. So let's pick up on the theme of investing in yourself. What exactly do we mean by that? What is financial planning at this point in time? Is there a particular time and stage in life which is really the correct time to start investing, or can one start at any point? Kalpesh?
When we say investing in yourself, it primarily means that you try to understand what is it that you are earning the money for. And when we say earning, it also has another side to it, is why are you spending the money and for what purpose? Identifying that purpose is of paramount importance.
Okay, Mehrab, talk about financial planning. Is it necessary to start in my 20s? Is it too late to do so if I'm in my 40s or even in my 50s?
Day one, when you start working, I think that is the right time you start planning about your financial future. I'll give you a very simple example. If you invest 10,000 rupees at 12% per annum compounded return per month, for a 25-year period, you will accumulate almost 1.9 crores. But that same 10,000, if you start 5 years early and you invest for the same 12% per annum return, compounded for 30 years will become almost 3.5 crores, which is double the money. And also you have to stick to your plans. Obviously, you have to review your goals and your plans, but you have to stick to your plans. The markets, the noise will come and go, volatility will be there, but you have to concentrate on your long-term goals, stick to your plan, and you will achieve your long-term goals.
So stick to your plan, and I'm glad you brought up the noise factor, because Kalpesh, if you talk about noise, if I'm a youngster in my 20s, chances are there'll be an insurance agent, there'll be a bank guy coming to me, I'll be getting those phone calls saying, sir, we have a very good investment plan. There is a lot of noise out there. Do I need to go to an expert to help me with my financial planning?
When you take the help of a planner or an advisor, what he helps you to do is cut out the noise. And how can you cut out the noise? The simple way is to sit with the planner or the advisor and tell him about your own goals, your own limitations, your own capabilities, your own earning capacities. And once that is highlighted, it takes the form of a financial plan. The financial advisor will chart out a roadmap for you to achieve that financial goal for you in life. And when we say financial goal, it is already bifurcated into short-term and long-term goals.
A financial advisor is an expensive proposition, isn't he, Mehrab? I mean, how many of us can actually afford a financial advisor? And usually he wants a ton of money. There is a cutoff before he actually takes on my portfolio. Is that the case?
The cost is much low when you compare to what services they give. What charges, he may have some charges, but the charges are minuscule compared to what long-term goals he can help you achieve. And Kalpesh very rightly said, he cuts out the noise. So he cuts out the noise, he puts you on the right road, and he ensures that you are on the right road throughout your journey. He is like a partner in your journey towards achieving financial freedom and your financial
But
goals.
a lot of young people out there, and myself included, when I was in their bracket, I used to think, listen, I'm already, half of my salary anyway goes away in EPF. So, I don't have too much to invest in any case. So why do I need to go to the trouble of going to a financial advisor? Just give me those basic, tick in the boxes. I should have some insurance. I should have some mutual funds. Kalpesh, is it as easy as that?
As a financial planner, the real, I think, expertise of a financial planner is telling you the don'ts. He knows that if you do not follow the wrong path, automatically the right path will be in front of you. Because today, the financial world or the financial products, it's a concrete jungle out there. And everyone is in there for their own meat. So you do not know what is right for you. And that is where the financial planner prominently plays a part in your life, highlighting that it is your life. Everyone's life is dynamic. Everything is different and dynamic, and you need to work in that capacity to achieve your goals and ultimately what I would call is financial bliss.
Okay. What should I really be clear with before I approach an expert?
When we start working, we will have different kinds of goals. We will have short-term goals, medium-term goals, long-term goals. Buying a car or something like going on a foreign vacation, that may be something like a short to medium-term goal. But planning for your child's education, planning for your child's marriage, planning for buying a house, and most importantly, planning for your own retirement, those will be medium to long-term goals. So you have to know which kind of goals you have to achieve, and accordingly you have to do asset allocation, accordingly you have to do financial planning for that, and accordingly you have to work towards that to achieving those different kinds of goals.
Okay, what are some of the instruments that you would say are the basic pillars of financial planning?
So if you have a time frame which is, say, anything up to 3 years, and you wish to achieve that goal desperately in the next 3 years, obviously, equity is a big no, because you need something which is more solid, more guaranteed, and it is not going to waver. So you need to invest that time in fixed income investments. So you do not need to look at fancy returns when you're looking at a short-term goal, because the time frame is very less. You cannot afford volatility or risk in that period. Now, if your time frame stretches to 5, 10 years and above, equity is the obvious answer,
okay.
And you cannot look at fixed income instruments for that, because that is the biggest risk there, because
okay.
They will not beat inflation.
Well, that was some great advice, and remember, you can check out all that advice and more using our website and also by using our Facebook and Twitter handles. We want to hear from you. The handle is @NSE FinWiz. Stay with us. There's lots more coming up. You're watching NSE FinWiz Season 6, powered by CNBC TV 18. Welcome back. We are in conversation with Kalpesh Ashar and Mehrab Irani right here in the beautiful Wipro campus in Bengaluru, and in conversation with our young audience and our financial experts into how you can make your money work for you. Investing in yourself, that's the theme. How do you invest in the right way, especially with the March 31st financial year deadline around the corner? For those of you who've been caught on the wrong foot and you still are yet to make your investments, what are the avenues still open for you? First of all, Kalpesh, one shouldn't be caught in this situation at all. But having said that, if one is caught in this situation, March 31st is just about 2 months away. I haven't yet completed all my investments. What should I do in this situation?
Tax planning should not happen starting January and ending March. In fact, it should start on 1st of April, and ideally everything should be in place by June. The common sections, Section 80C, which has got the limit of 1,50,000, Section 80D, which entitles us for the health insurance premium, or the Section 24, where we have the interest on housing loan. If you see this in detail, all of them form a part and parcel of everyone's financial profile. So EPF, which is a 12% of your basic salary, goes towards that. That takes care of the fixed income part. If you wish to invest in equities to get the tax deduction, you have the ELSS in mutual funds. Then to protect, what do you need to protect? You need right insurance. And for that, we've always told everyone that term plan is the best way to cover yourself, and the premium you pay for that suffices.
Let's talk a little bit more about insurance. This is the time when you're inundated with calls, with all sorts of very confusing schemes. A couple of years down the line, you find yourself sitting on an investment which has been a dud.
Getting an investment come insurance product, if you see the fine print, neither does it cover you substantially on the life cover front, nor do the returns even tend to beat inflation over a period of time. When you go to a doctor, I just like to give a small analogy out here. I'm talking about insurance out here. So if he gives you a tablet, which is an antibiotic, so you know that antibiotic is going to work individually to protect me against any type of disease or some bacteria, whatever it is. Now, in that tablet, if he tries to give you a protein, neither the effect of the antibiotic is going to work full force, nor is the protein. And this is exactly what the insurance cum investment products do.
When one is working with a company, one says that, listen, I have my corporate insurance there, so do I really need to make that additional investment into health insurance? When you look at the tax benefits and also the longer term benefits, what are the pros and cons?
Even if you're working in a company, you should take your own health insurance. Because number one, you remember that health insurance with the company is only till you're working with that company. Say if you leave the job tomorrow, that health insurance also goes with it. And as your age passes, the premium also keeps on increasing. So if you take at a younger age, you get at a much lesser premium. Also, if your company is paying for health insurance, you must check for the terms, whether it covers only you, whether it covers your spouse, your children. Many companies do cover, some companies don't cover. So there are different terms and conditions. So I think you have to study all of them. But even if that company is covering, I surely advise that you have to have your own personal family health insurance cover as well. I think that will be a permanent protection against any kind of untoward incident.
Okay, great. Let's take questions, and we've got some interesting questions. Shiva Goel?
Actually, I wanted to know that whether it's beneficial to take term plans or ULIP.
Pure term plan is always preferred. The simple reason behind it is it has got maximum cover at the least possible premium. So just to put a figure in place, that if a 30-year-old individual wishes to have a cover, sum assured cover of 1 crore, he or she would be paying a premium of not more than 8 to 10,000 rupees per annum, which is not more than, I think, 700 to 800 rupees per month.
Yes.
So you can't get more reasonable in covering yourself
than term insurance.
Term insurance. And ULIP, it's still got that element of insurance and investments embedded in it. There is high charges which are still going into it, and now to even see the performance of an ULIP, it becomes again a long holding period investment. So you need to wait for 15, 20 years to actually benefit from a ULIP. In that case, you are better off taking a mutual fund.
Okay. Next question is from Sanjeev Rao, Katakam.
Like, we are mostly looking at the options within India. Is there a possibility where we can invest outside India and also, say, save tax?
You can surely invest in overseas market. There are some limits of 25,000 US dollars, etc., which you can explore and invest. You must remember one thing, that if you're diversifying abroad, you are taking that kind of a risk. So you have to understand that kind of a risk to take that. Plus, if India itself is a high economy, high growing economy, then it's always better to invest in the Indian economy, which is itself high growing, which you understand also better.
Okay, on that note, let's take a quick break. You're watching NSE FinWiz Season 6, powered by CNBC TV 18, coming to you from the Wipro campus in Bengaluru. We'll be back with more. You're watching NSE FinWiz. Welcome back. It's time for us to take questions from our audience members, and they're raring to go. That's right. These are all employees of Wipro here in Bangalore, and they've been listening in to what our experts have to say. Now it's time for their questions. So who wants to take off first? The young lady in yellow, yes?
So I wanted to ask, what if we have made a wrong investment in any insurance, and how do we realign?
So let me just rephrase that. She wants to know what are her exit options once you've been sort of seduced by these plans, insurance plans.
First thing is rectify the wrongdoings. First, take a term plan. Because if that is missing in your armory, I think you're doing no favors to yourself and your family.
Okay.
So take an appropriate term plan with sufficient cover. Once that is in place, you need to review your erroneous insurance policies, what you're mentioning. If the damage has already been done substantially, you might as well just end it there by paying the next couple of years and just calling off the whole thing. If you've just gotten into a policy, then I think you do not need to prolong the damage. Because then you have the policy in front of you. You do not wish to pay out of your skin for something which you've realized that you've done something wrong, and there are two options. You either make the policy paid up, which means you stop paying the premium, and you have a term plan in place to protect you already. And the other option is look for the surrender value. Now why I'm asking for the surrender value is that although you will get a very depleted amount in your hand, at least that amount which you get, albeit at a loss, can be reinvested immediately for the long term, which we call the time opportunity cost.
Right. Okay.
And that makes up for the loss which you would have incurred if you would have gone on making the same mistake.
Okay, so cut your losses.
Cut your losses.
is I think the bottom line. Great. Who's got the next question? Yes.
I have been investing in SIPs from last 2.5 years. So the status is now the amount which I have invested is equal to the amount of market value of the units right now. So it has not gone too up and not too down. So what should I do right now? I should evaluate the holdings of the funds, or I should change the funds. What should I do now?
Mehrab?
What you have started is a very good thing. It depends on what was your goal and what was your time horizon when you started. But you have to remember that SIP is something which helps you get rupee cost averaging. So you get the best average. You invest during up times, during down times, during normal times. And you have to distinguish between volatility and return. Just now what you are talking about volatility. You have not earned your return over the short term and because of volatile times. But if you stick to your goal, if your original asset allocation was right, if your original goal planning was right, if your original selection of funds was right, then I think you should stick to it. Because over a period of time, by the time you reach your goal, I'm sure you will achieve return. Because market moves in different kind of cycles, and SIP helps you to take advantage of all kinds of cycles.
So you would advise him to continue with the SIP?
I would advise him to continue. If your goal, say you have done this investment for say next 10 years, your goal was a long-term 10-year, 15-year goal, then and the fund selection and asset allocation was right, then you should surely continue with it.
Okay.
Eventually it will. By the time you reach your goal, it will rise.
Yes, the gentleman at the back.
My first question would be, as financial advisors, what's your take on cryptocurrencies? And my second question is, should we have a part of our portfolio into cryptocurrency or not?
Do your asset allocation properly based on your goal. And out of that, some money, whatever you want to lose or whatever you want to play with, you keep it aside. That money either you can put in cryptocurrency, you can do horse racing, you can go to a casino, whatever you want. See, that is for your entertainment. So whatever you do you separate your entertainment with your financial goals.
Simply speaking, there is nothing as an underlying asset when you invest in a cryptocurrency. It's all virtue. Okay, even if, like what Mehrab said, to carry on the lightness forward, even if you are doing horse racing, speculation, there's a certain horse running in front of you. You can see the horse, you can see his movements, and you can egg him on. What is there in a cryptocurrency? And it's not my theory, it's crashed badly. Majority of global governments have decided to not recognize it.
Okay, but that just shouldn't stop the questions. Yes, sir.
Does it make sense to invest in real estate? Because if even your FD is giving 8% plus and equity gives, let's say, 15% plus. So if we totally avoid real estate, will it be okay?
Real estate also is an asset class which moves according to cycles. But the problem with real estate is that it is highly illiquid. Point number 2, buying real estate as your first house, we are all for it. If you are looking at it as an investment, the returns are not at all favorable. And how many people, practically speaking, even when real estate is up and running, have been able to sell their properties and been able to capitalize on it?
Right.
Because then the element of greed comes in.
Correct.
That was some rich advice. Thank you so much, gentlemen, for all your takeaways. And I'm sure our audience, our viewers, will be benefiting and profiting from it. That's it on this edition of the NSE FinWiz Season 6, powered by CNBC TV 18. Remember, there's the website, and we also want to hear from you by using our Twitter and Facebook handle @NSE FinWiz. Until we meet again, goodbye and thanks for watching.
As a person who doesn't know too much about financial planning, financial investments, and who's always dependent on either a father or my husband now for any kind of investments, at least I got to know, certain basic elements about financial planning as to, some terms that I never knew about, I at least got to know. So at least basic things I know that I have a little knowledge about, which I can further strengthen about and stuff in the near future.
I feel the event was very informative. For me personally, I picked up some really good advice from what the experts said. I especially found the section on tax planning very timely and helpful. I think I'll use the advice that I picked up today for my tax planning.
Found the session very interesting and very useful for all the prospective investors in this world. So I learned how to make a mix of the debt and the equities in your portfolio, and how to do the planning as at the beginning of the year as well as at the end of the year.
Focus. Ideate. Innovate. Enable.